Global markets are in turmoil on Monday. People are comparing today to October 1987, Black Monday. They're certainly showing signs of the same kind of pattern abroad. Korean markets saw a circuit breaker triggered. Korean markets are down 8.7%. The Nikkei is down 12%. We'll talk about Japan in just a bit. The worst day since 1987. Here in the US, the NASDAQ composite is down 2.4% on the trading day. It's off its lows a little bit, but still very much in selling fear territory. The S&P 500 is down 2%. Bitcoin is leading the charge of all the cryptos, down today 5.6%. It's down about 20% over the last couple of days. So huge sell-off. Gold is down as well, down 1.5% to $2,400. The 10-year yield is slightly flat, but there's been a huge rush to bonds over the last 48 hours or so as this global sell-off continues, starting from last week's weak unemployment numbers. Chris Vermeulen joins us today to talk about what's going on, what's next. Welcome to the show. Welcome back, Chris. Chris, as you know, is the chief market strategist at TheTechnicalTraders.com. Good to see you, Chris.
Hey, thanks for having me, David. Yeah, it's a pretty wild day in the markets, that's for sure. A lot of people running for the fences.
What was your first reaction? I mean, this happened overnight, of course, as the futures markets were already down. But what was your first reaction waking up this morning?
Well, it's a Canadian holiday, so I woke up, I saw the markets, I go, well, I guess I'm going to be working today. There's going to be a lot of people who need some soothing of the soul. But overall, I was like, I wonder what hit. I mean, I know Warren Buffett came out and finally we got to see exposure that he's sold half of his Apple position. He's got a massive following around the world with big players. So I was wondering how that would play out. Not saying this is related to it, but I'm sure that has definitely added to the downside. But we're really seeing a big washout low, and we can see that across the board in the type of price action that's actually unfolding today. Last week on Friday, I was talking about how the NASDAQ still had quite a bit of downside, 4 or 5% to the downside before it was actually going to have this measured move and have a bounce. And it gapped right down to that level this morning, and it's been ripping higher. So there's a lot of technicals we can go through as we go here, but everything's showing that the market has completely washed out short term, a lot of fear, and everybody's kind of ejected out, probably at a intermediate low here on the charts.
The Magnificent Seven is set to shed about $1 trillion today. It's led by Apple going down, Nvidia. So yeah, Warren Buffett did release on Saturday that Berkshire sold half its position in Apple stock. The point I'm trying to make, though, Chris, is that people I've seen online are already talking about buying the dip, this massive, if you even want to call this a dip, right? So is that the play that you would take?
Not so much. I mean, we got out of our long positions in the market about 2.5 weeks ago, 2 weeks ago. So we've been on the sidelines. We're just kind of letting the charts, the internals were saying something was up. There was all kinds of chaos. So we've been sitting on the sidelines. With that being said, if I was a short-term trader, which I used to really focus on, today's huge gap down, we saw the VIX up 176% this morning, which is massive, which is telling us there is huge fear. My panic selling indicator volume ratio this morning at the open was above 60. That's anything over 3 is big. So 60 is like ridiculous. Everyone's panicking. So this is the type of play where it gaps down and you wait a few minutes to see how it's going to take hold. And you could play like the rally. This is like a counter trend trade. Market just gaps down extreme, pure panic. And then you play the bounce. If you look at almost all the Magnificent Seven, pretty much everything actually today, it opened and then just started to rally, and it's been ripping higher. And that's because it was an exhaustion move. I think the whole world kind of dumped their shares in overnight trading and pre-market. And there are bargain hunters right now stepping in. That's why it's driving itself higher. People are like, this is a buy. People are in the buy the dip mentality. I don't believe we're going to new all-time highs. I don't think in this stock market now. I think there's some damage being done here, but I do think it's going to bounce and rally for potentially. It could go higher and sideways for several weeks. And that's what I think some people are taking advantage of right now.
Before we continue with the video, I'd like to tell you about the precious metals sector. Now, gold, as you know, hit record highs in 2024. So the question on everybody's minds is, what should we be following and tracking in relation to gold? Well, I'm here to tell you that Stellar Gold is a name to watch. Stellar is a leading gold developer with 2 cornerstone gold projects in Canada: the Tower Gold Project in the prolific Timmins mining camp and the Colamac Gold Project in the Northwest Territories. The company has a massive global mineral resource estimate, one of the largest in Canada for a gold developer. Its young and ambitious management team, with a track record of success, is aggressively advancing its projects and is determined to unlock significant value. If you're looking for a team who is as enthusiastic about gold's future as you are, then check out stlrgold.com/David Lin in the link down below, or scan the QR code here, where David Lin viewers can sign up for their macro gold newsletter to get inside knowledge and updates for free. Higher and sideways for several weeks. So, are you waiting for indicators to go back in? Chris, you said you're out.
Yeah, so if I show you my chart, I'll show you kind of a
Yeah.
visual of what I'm looking at here. So from a short-term kind of technical bias, when we look at the short-term 30-minute charts, about a week and a half ago, the trend went from green to red, and we had this SS, which is like a sell short. The market's changing trends. A couple of days ago, we had another signal. Typically, when we get these, the market goes and sells off. Now, when I go and I look at the multi-week potential bounce that I'm just mentioned to you there, David, that is kind of like we've had this big measured move sell off, and now it's bouncing today, and it might end up bouncing and working itself up. Maybe it'll make like hit some falling trend line and then eventually fall off a cliff. But this is a daily chart. So it could take several weeks to work itself out and build out what could be like a bear flag pattern, which it could chop around through here. And then it could have the next major leg down. This would be the first leg and then a bear flag. And the NASDAQ is a really good example of this. This is the one because it's heavy weighted in tech. This is the index I'm kind of looking for to get a gauge of when the market is going to find a bottom. And using my favorite indicator, which is Fibonacci extensions, we can base everything on the momentum of this chart. And what we have here is the market had its first leg down. Whoops. And then, and then it bounced higher. And now it's sold all the way down to this one level. This is the 100% measured move. So it gapped there this morning. And now I think we're going to go into some type of sideways bounce and pause before potentially it goes lower. So that when I say I think it's going to bounce and go sideways for a few weeks, I think it's just going to grind its way up. It's going to be choppy. It's probably going to form a bearish chart pattern, which, a month from now could roll over and go a whole lot lower. That's anticipating.
Now, you and I talked about cycles a lot on my show, so maybe we can show the audience one more time these cycles. Are we in a stage 3 topping pattern? And if so, is this the beginning of what could be seen as a stage 4 decline? Chris, or not yet?
Yeah, I totally believe we're in this stage 3 topping phase. A lot of people will say, well, the stock markets have been hitting new all-time highs. And yes, the NASDAQ and the SP 500 that are tech heavy have been making all-time highs, but the majority of stocks, if you look at small caps, micro caps, and equal weighted SP 500, and if you look at them or blended them all together, they've actually formed this move where we saw the market top out in 2021. And then they're forming this sideways move. So I believe we are still in this kind of sideways pause here, grind higher before we go off this cliff. And until the technology space loses its upward momentum, stalls out, and starts to head down, we're not really going to enter that stage 4. But I mean, I believe we're in this topping phase. All the signs are there. Gold's been hitting all-time highs. Energy stocks have been up near all-time highs. Industrial stocks have been near all-time highs. All three of those are indications that the market is topping and stalling out, and the economy is also about to come to an end, which we can see in rising unemployment and non-farm rate, payroll numbers, all this stuff. So the signs are all there. It's just a matter of letting the noise and this chaos just kind of unfold until the overall upward bullish bias stalls out, grinds sideways, and then breaks down. And I think in the last couple of days, the big drop we've seen is really just kind of a shot across the bow saying, okay, I think the upward momentum has now stalled, and now it's going to chop around and kind of try and figure out what it wants to do here over the next couple of months before potentially going a whole lot lower.
Just looking at this chart you have on the screen here, I've noticed that it's pretty important that once you get to a stage 3 and then a subsequent stage 4, the stock market is trading below its moving average. And we can define whatever time period for the moving average that you like, 50-day or 200-day moving average. And whenever we're in a bull market like stage 1 and 2, the stock market is trading above its moving average. So can we take a look at how the stock market is doing currently versus its moving average?
Yeah. So just based on this chart, so this is based on my favorite is the daily chart. The moving average you can use is like the 150-day moving average. In general, if price is above it and the 150 days sloping up, you're generally in a bullish phase. If price is below it or it's flatlining, you're in either a big pause or a stage 3 top or potentially stage 1 basing. You just need to figure out where you are. So if we were to go and take a look at this market, we could turn this into the 150-day moving average. We can get an idea for this, which right now you can see we've kind of been bouncing up this 150-day moving average. Today, we broke below that. I think it's going to regain it. I do, again, think we're going to see this market probably bounce up, form some type of price action here, and probably get really choppy. But I do believe, this blue line, this 150-day moving average will eventually flatline. Price will start to break through it more often, and eventually it'll start to slope down, and then price will also continue to move lower. So we are threatening the 150-day right now, and we have all the signs again that we're there. We have big volatility, huge rally, huge sell-off. Volatility usually means we're near a major turning point. The bulls and bears are fighting, and so, yeah, it definitely looks like we're forming that. And if you go from a technical standpoint, if you look at chart patterns, how I drew this shoulder here, people will be like, well, this looks like a shoulder, a head, and another shoulder, which is a head and shoulders pattern, which is known as a topping pattern. And you draw a neckline across these lows. And when it breaks that low, the distance from the head down to the neckline is usually the downside potential target of it going further, which will bring us way back down to the lows of last November, October, November. So there's a lot of downside potential, even from where we are now. It's still showing about a 20% drop. Of course, that's from where we are now. I do think eventually we'll probably be somewhere up in this area. So there's a lot of volatility. We just need to let this chart pattern unfold and then also see cycle wise, sentiment wise, where is money flowing? Is money flowing into the dollar, into gold? We have so much panic selling today. Everything is pretty much down, as you mentioned earlier, David. And that's indicative of like a bear market. When we're in a bear market, you really don't want to hold many assets. There's nothing really that goes up. Maybe the dollar, but cash and just earning interest or an inverse ETF are really the only ways to go. It's not about being diversified. It's about removing risk and sitting safely on the sidelines.
Before we talk about money flows in the next chart, I just want to point out how calm you sound right now. I can just tell by your voice. You're not, I guess, not in panic mode, which is what we're seeing in the charts, certainly, which leads me to my next question about psychology. A lot of people wake up this morning and they're probably also in panic mode, and the instinct right here is to sell,
Yeah, totally.
And I just want to ask you how people should react, what questions they should ask themselves before pulling the trigger on either a sell or a hold or a buy decision.
Yeah. So a day like today, like the VIX tells us people are freaking out. Our panic selling indicator that we make tells us people are panicking. That's what I specialize on, is keeping my followers and investors having their mind in the right spot. This is what's unfolding. This is what's going on. We're not in the markets. We've already closed out our positions. We're actually making money today, sitting on the sidelines, just earning daily interest while the markets are falling apart. But a lot of people are panicking, and we've seen this coming. The charts were telling us something really gnarly was about to happen. So we've kind of liquidated, and people are panicking. And I mean, people will go through this emotional roller coaster cycle as we go through all this. But I mean, I was told the other day that I'm the David Attenborough of the stock market. They're like, you're such the calm sound of, how the markets are going, what to expect. And the key is if you know what's going on in the markets, even if a big sell-off comes like today, like you shouldn't be getting anxiety. You should just be like, okay, well, that was, bound to happen. It's just a matter of time. And you should already be positioned for, these phases where most people lose money and they're in denial and they're panicking and panic is today. If you're stuck in those situations, you don't have a strategy. You're trading on emotions. You're not protecting your capital. You shouldn't be stuck in situations like this, really. I mean, you should have caught the big rally up from last
Yeah.
November. And you should also have an exit strategy to be like, hey, if things are breaking down, we want to move aside. It really does come down to psychology. I mean, understanding your personality type, like the Myers-Briggs. I did an article on knowing your investment personality type, and like 81% of people have a personality type that doesn't favor you managing your own money. You are going to have serious problems fighting your self-discipline, all kinds of things. Your emotions override you. So it's super important to know your personality type. And based on that, you make sure you get the proper help you need to execute. So a lot of people really need the trades done for them, like auto trading, which we do, or they just need to follow trades, but they need a sound voice, which is what I do. I stay on everybody every day, every morning. I say, this is what's going to happen. Everyone's going to panic today. We're not, because we're already out and we've already seen the momentum shift. So yeah, it really comes down to understanding your personality type and having strategies in place so that you're not caught in these scenarios.
Here's the thing: the Nasdaq is currently at the lowest level since April 30th, May, basically. So it's wiped out all of its summer gains. If I'm a trader or an investor who got in before May, meaning I got into the index, before this rally happened and the subsequent decline, I'm 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 not down per se, but I'm panicking in the sense that I think I could be down if this sell-off were to continue. Right? If I were to
For
hold,
sure.
I'm going to be down. So now I'm thinking, well, let's just lock in some profits now, see what happens. And I
Yeah,
think
for
that's
sure.
what a lot of people are doing. That is that the right approach?
Yeah, you definitely need a strategy to lock in profits. I mean, the momentum and the signals have changed direction from an active investor standpoint. I got a call from somebody the other day. They were saying how he finally convinced his wife to buy Nvidia. They bought it several weeks ago, right near the top, and he was like, "I don't know what to do. She's gonna whoop my butt if she finds out how much it's down. What is the trade? I can make it back." So we definitely have FOMO of like finally, yeah, like those who've been holding off forever are moving into the space. I mean, if we take a look, like this is the strategy that I use here, the CGS strategy, which is this solid blue line at the top. Constantly, we just close out our positions. We're at all time highs with our account value, and if you look at how we're compared to the SP 500, I mean, the SP 500 has fallen like 5, 6%, 7% since here. We've doubled the return of the SP 500. The buy and hold is down even more just year to date. So it's all about managing and locking in gains, protecting your capital. And the thing is, we don't get big pullbacks like this that often. And when they do extend and last for several months or several years, the problem is they don't happen very often. So people don't understand the value of locking in gains, protecting capital. We do miss some trades, some gains to the upside, but it's more important to protect your capital than to take a bunch of big losses. And so that's the real key here, is making sure that when the market rolls over, like we got out, somewhere right over here, this market could very easily just go into a huge waterfall sell-off. I mean, it could get very, very ugly. And that'll wipe out all of this year's gains, and people will be underwater potentially a month from now, right? So it's very important to understand, to have a strategy. Most people don't. That's why people are trying to pick a top. That's why they're buying inverse ETFs, buying put options. All that stuff is really guessing. You can't pick a top. You can't pick a bottom. You have to follow a trend, but the trend needs to change direction, which it has now. It's just a lot of wrong mindset, I think, with a lot of traders thinking they always need to trade, they need to be in trades, and they always want to try and sell near a top and they want to buy on a low. But all of those are counter trend trades, and they're very dangerous because they're guessing.
At what point can you make the call that we're in a bear market? What are the trends or definitive signals that you need to see to make that call?
Yeah. So on the daily chart here, we'd start to see some pretty big breakdowns. This will probably, whoops, this is going to be a very significant standout low here. This one also. But when I go for bear market view, I usually go to our weekly chart of the SP 500, and I like to look at it from a weekly basis and just identify, when the technicals confirm when we're in a bullish phase. They'll tell us when we are in a bearish phase. We're still, as a long-term investor, we are still in a bullish phase. So if you had like kind of somewhat passive money, you're like, I'm just going to be long during the bull markets and I'm going to move to something safe where I just earn interest during a bear market phase, you'd still be holding on because it hasn't broken down. So we're waiting for our bull bear market signals to flip. And when it does, that's when we start actually looking at playing inverse ETFs once all of our charts line up so we can profit from falling pricing. And I believe, eventually I think we're going to see a very, very big correction in this equities market. I think we're going to see
A big
a
one. I
huge
mean,
breakdown.
the
I
the,
think we're
the
going to
sorry
break.
that the one we got last week wasn't big enough. What do you
No,
mean? Like,
gosh, no. It's nothing. It's just a pullback. I mean, look at this pullback just recently. That
yeah,
pullback is the same that we've had over and over and over and over and all the way back. Like it percentage wise, this chart is lower valued. Percentage wise, these are
yeah.
all about the same size pullbacks. It really is just a technical washout of the market, trying to figure out if it's going to shake everybody out and go higher or if it's the start of a new breakdown. Now, our technicals from a weekly standpoint here have completely broken down. This market is pretty much broken. We just need a bit of time and we need the technicals to break down a bit more. But where we are right now, David, is actually very similar to right here. Like we're potentially a few weeks away from our
Oh yeah.
strategy saying we are kicking into a bear market phase. The question is it just like a 20% bear market or is it like a 40 or 60%? Do we break the lows from 2022 and go back down to potentially the COVID lows? Like, who knows how big this break is going to be? The nice thing about technicals of what I do is we follow price, we ride the trends. So it doesn't really matter how far they go. We just hop on the trends when they're in favor and we trade them. But it is definitely going to be very, very interesting over the next several weeks how this market unfolds and if it can hold up or if it is going to start a new bear market phase here.
I was going to ask you whether or not this looks exactly like 2022. Yeah. If you just take a look at this pullback, it could be applied to any start of any bear market, right? So, what in particular does it um, stands out to you in terms of a parallel between now and 2022 or late 2021, rather?
Yeah, so there's a few things going on. I mean, we're seeing precious metals perform very well, but behind the scenes, from more of a technical standpoint, we're seeing money moving out of the large caps in a big way. The large caps are more so big investors. If you go to any baby boomer, any massive stock market investor, they're heavy into blue chips. They're heavy into dividend stocks. Those are all big, large caps. And we're seeing huge money flow out of the large caps. Some of it's been flowing into the small caps, which is why the Russell has popped. We've had really big mixed signals in terms of money flows between like I follow the money flows and the volume on the New York Stock Exchange. It's interesting because we have a huge day of massive selling in the Magnificent Seven. And then we see the Russell 2000 rocketing higher. And we actually have like FOMO buying, like people are diving into small caps left, right, and center while they're
Yeah.
dumping the large caps. And when we get these really big mixed signals, it's never a good sign. In fact, the Russell 2000, if we take a look at it, has done a pattern that it did just before the 2000. I'll just go to the weekly chart, just before the 2022 bear market. So if we were to take a look at it here, the Russell 2000 kind of put in a pause. The overall growth stock market topped out early in 2021, but then we saw everybody pop into small cap stocks very, very quickly. Everybody doing exactly what they just did over the last 4 weeks. If you look here, we've had the Russell 2000 pause, and we saw everybody pile into small cap stocks, and then we went into that 2022 kind of bear market. We're having the same setup. This is also the same setup. If I was to go back to 2008, we saw the same thing. We saw small cap stocks have their pause. They had a great big pop and rip high. Everybody thought it was the start of the next big move, and then we went into the financial crisis. So money is shifting, and it's all over the place. There is no really clear direction right now. I know you're probably looking for a super clear direction, but
Yeah.
because we have all these mixed signals, our strategy just says like go to cash and protect yourself until there's something worthwhile hopping in. Bonds like TLT are very close to generating buy signals for us. They've been out of favor since the COVID crash. So sometimes you just don't know what to do, and the don't know what to do. The cash position really actually is a position. Just people don't like it because they think they need to be in trades. But I'll tell you, we're calm and cool and collected all because we moved to cash a few weeks ago because all of this chaos in the Russell, the large caps getting dumped, the growth stocks popped for, in my opinion, no reason at all other than people are chasing the markets higher. They're saying, well, I'm getting out of the big tech because they're fizzling out. I'm moving back over to the super fast growth small caps. And then whenever we see this stuff, it's like, something's changing, time to liquidate.
I keep seeing in the headlines that markets reacted on recession fears in the U.S. And now I've had various economists on with various opinions on whether or not we're actually in a recession. But the fact remains that perhaps this is a market signal. Are you reading into that at all? Last Friday's jobs report came in weaker than expected. 4.3% unemployment ticked up.
Yeah, I am. I mean, when we take a look at I think for sure I mean, I don't follow the economy stuff very much at
Yeah,
all,
sure.
but like when we look at the economic side, everything is telling us we are near a stock market top. Sector driven market. We've got all the main sectors and commodities performing how they should when the market's topping. And now we've got non-farm payrolls, unemployment rising, which is this yellow cycle. And it's telling us it's starting to roll over. So we're like literally right between in this crevice of the stock market is topping, the economy is stalling and topping. So the perfect storm is brewing, right? And it's going to be another huge financial reset. The fact that Berkshire Hathaway's got like $300 billion just sitting in cash, liquidating. I mean, and all these other assets. We have been seeing money flow into the real estate ETF. People are trying to get out of the stock market and they're trying to go to different assets. Now, the real estate ETFs are not the way to do it, but people have been moving into it. For example, like IYR, if I pull this up, we have been seeing people rotate into IYR. Let me go back to the daily chart as kind of that defensive play. We've been seeing it move up really nice while the stock market's been going down. That's because people are nervous about stocks falling. So they're like, oh, I'm going to go buy real estate ETF. The thing is, the real estate ETFs are a bunch of companies, obviously traded on the stock exchange, or that's what it holds is a basket of those. And so when the stock market does correct, these ETFs get absolutely annihilated. If you go back to even like the 2008 financial crisis, getting into a real estate ETF, I mean, you'd lose 76% of your money during COVID. It's not a safe play, down 40%. I believe it's going to break down again and have a huge correction. So this just goes back to people are trying to get away from growth stocks right now. Over the last week and a half, they're trying to get out of the large tech and they're moving to real estate ETFs, but they don't realize that anything that's stuck in the stock market that's publicly traded is going to get hit. It's the way it works. When the tide goes down, all boats go down with it. When we're in a bear market, all stocks go down. There'll be the odd group that might buck the trend, but there are hundreds of groups. The odds of picking the one and timing it is very slim. You're better to just play the odds of benefit from falling pricing or stand aside.
If you had to pick one safe haven asset to be in besides cash right now, what would it be?
Um, can I say the dollar index? It's not quite cash, but it is cashish.
Yeah, sure, I guess so. Well, the dollar's been weakening versus the Japanese yen. We'll talk about the yen in just a minute, but yeah, why the dollar?
I just believe the dollar is going to work out to be a long term. I think it's going to be strong as the economy kind of falls apart. It has been trending up for many years. It had a big leg up and now it's consolidating. I believe it's building a base. This could be a bear flag. It might pull back further. But if the stock market and things start to break down, I do believe we're going to see it have another push up to the 116 or 120 area, very similar to the 2000 or earlier when it did the same back in time as well. So I like the US dollar. I think when all hell breaks loose, it's naturally going to kind of perform and be fairly stable. So that's kind of and I like it because it's slow moving. I mean, even if you're wrong, you're not going to get slaughtered in it. I like when there's chaos, I move down an asset hierarchy, which I talk about in my book. And we always want to be in the riskiest assets, which are equities. But if they're not in favor, moving in the direction we want, they're not strong enough technical wise, then we move down to a different asset class, could be bonds or the dollar. And as we move down that list, each asset moves slower and slower, which means it has less risk if you're wrong. And you usually want that because as we're moving down that list, the markets are getting wilder and crazier and having swings like today. So, as the markets are falling apart, we're sitting in something very slow, and it's all about protecting capital. I mean, that's the phase most people who are invested in the stock market are at. You don't want to lose your money, but you want to keep growth. So we just kind of rotate, reinvest into one asset at a time, depending on which one is favorable.
How do you feel about treasuries then? US 10-year, for example.
Um, I mean, I like bonds in general. I think like TLT is a type of play that I think is going to do very well. This is the daily chart zoomed way out. It does have all the characteristics of a major bottom. I'm pretty personally, I'm heavy into cash. I have a lot of just government bonds, just things that are an interest without any downside risk. That's where we've moved our portfolios. We're sitting in like BIL, short-term notes, just to collect interest and get paid out in dividends. We've seen a big pop in bonds recently. People are more or less expecting the Fed to step in. I mean, I read some posts this morning of people saying, all hell's breaking loose. The Fed needs to step in for emergency rate cut. I mean, it's a
Yeah.
1 day drop. I mean, we've had 2 days of falling prices, but I find it so funny how many people are just wait on the Fed to save the day. But it's just a 1 day, 2 day drop, and I think it's a short term pivot low. I think the market's going to bounce for a bit. I do think bonds will be a very good play over the next year or two. I think they could do very well. They haven't fully bottomed yet. We're still a week or two away potentially from bonds confirming that the momentum has shifted to the upside. It looks very, very nice, but we're not quite there yet. It could still sell off and have a drop.
Well, do you think the Fed needs to issue an emergency rate cut, either in response to this or in response to what appears to be weakening economic data? What's your take?
I have heard the economic data seems to be really bad. I heard a lot about like a lot of businesses can't pay their rents or their loans.
Sure, sure.
I don't follow the economic data too much. I generally, if it leaks through and gets to me, I know it's getting pretty bad. So I do feel like the economy is definitely, because I don't listen to the news, but I feel like things are slowing. Maybe the Fed does need to start to do something. But I don't think the stock market has fallen enough. I still think they're very heavy weighted on the stock market. I could be totally wrong, but I've
Yeah.
always just followed what the Fed does based on the stock market. I've never really got into the economic side. But the stock market was at all-time highs just a couple of weeks ago. It has had a pretty decent pullback, but in the grand scheme of things, it's not that bad. So I don't think they need to step in yet. I think if they step in right now, they're going to just show their hand how sensitive and they're willing to jump and save. I think they need to be more of like, no, they're out there as safety, but they're not just going to like turn on a dime and do a rate cut to save everybody because a 2 day drop in the equities market.
Can we take a look at the Japanese yen now?
Which one?
Some Japanese yen, so yen, a yen versus dollar chart. Now, people have been talking about the reverse carry trade as being one of the possible reasons for why the global stock markets have been selling off capital, rotating out of stock markets, going back into Japanese assets. So if you take a look at the yen, it hasn't moved like this since like the 90s, in a straight line down, right?
I'm just trying to find it here. I don't follow it too closely. Where is the yen?
You can just you can go on trading view and type in yen, for example, just to illustrate the point. And of course, we know what happened in the late 80s. I bring this up because, well, first of all, in the mid 80s, we had a huge appreciation of the yen, similar type of move, but obviously more protracted. And the Japanese markets, the Nikkei, like I mentioned in the introduction, are seeing their worst single day drop since 1987. It's
Hmm.
literally been more than 3 decades since we had this measure to move. And I know maybe you don't follow or trade currencies, but just from a technical perspective, you're looking at, yeah, it goes that one USD Jap, yeah, uh, you're looking at this move downward. It's a straight line downward. And I just want to get your reaction to this chart.
Yeah, I'm just going to drop to a weekly chart if it'll let me pull it up.
Yeah.
Yeah, so we're definitely I feel like we're in a reactionary move, right? I think the BOJ did a whole bunch of stuff. They stopped giving out money or they changed the rates, something big, right? And so this is a news event driven move, which is why it's straight down. I think it's affecting other it's affecting the markets around the world.
Yeah.
Last time we had, I think, we've seen big moves like this before. I feel like just visually looking at this, I think it's very close to like finding a short-term bottom, and it looks overdone. It's coming down to a support zone. It's really hard to gauge when it's a news-driven event, right? It's picking up speed. The volume is very, very big. And so typically when you have massive volume that dwarfs everything else, that is a true indication that something has sparked it. So this is an emotional move to the downside. I think it's trying to find support here. I think most of the downside is done for, this is a weekly chart. So probably see it bounce a lot like actually the equities markets. I think we could see a couple of weeks of higher and sideways pricing. But there's no doubt there's been a huge shift in what's happening over like in Japan, and that this could be a signal that a top might be starting to form for the yen.
Okay, great. Thanks for the update, Chris. I'll let you go. Before we go, where can we go to follow you?
Yeah, they can go to thetechnicaltraders.com, which I share. You can get onto my free newsletter list, and I share all my trades, which are all ETF based, more or less. If you need a strategy, you want to profit from falling markets, rising markets, sideways markets, you want something just or done for you, I provide automated signals to get executed in your trading account. Every morning I do a video like this. If you go to my YouTube channel, The Technical Traders, I post a video occasionally there to keep you up to date. I put one this morning that walks through the markets at a very granular level. And yeah, you can just copy the trades I do. I take all these with my own investment capital. This strategy I built for myself, and I just share it with others so we can all benefit together from it.
Okay, good. I'll put the link in the description down below. So click on that link to follow Chris. Appreciate it. Appreciate your update. We'll speak again soon.
Thanks, David. All right, take care. Bye-bye.
And thank you for watching. Don't forget to like and subscribe.